Okay, what the F is this guy smoking? Because let me tell you, this has got to be the craziest headline I have seen on a clip from CNBC in a very long time. And this is a very respected individual on Wall Street. This is Jefferies David Zervos. This says on the August jobs report that came out on Friday, 20,000 jobs lower than expected, unemployment rate that went downwards, but not as much as expected. The unemployment rate actually went from 4.26% down to 4.22%. Big deal. It's like we barely got a rounding, lower jobs report. Long story short, he says, you're going to laugh at this. He says, it wasn't bad enough to get us a good reaction. Oh. If this is what Wall Street is thinking right now, yeah, we're screwed. We're screwed. Like, I'm not actually going to play this clip because I think it would waste your 4 minutes of time out of your life. And I don't think that makes a lot of sense because the markets want a good jobs report. If we had 200,000 plus jobs, the unemployment rate went down an actual 1/10%, like 0.10%. Like if we went from 4.26% unemployment down to 4.16% unemployment, markets would have soared like nobody's business. A good jobs report is good at this point. A bad jobs report is bad at this point. We're back to normal. Normalcy is, well, too far-fetched for Wall Street these days. I mean, I guess I just felt like starting this video with that because I think that in a nutshell kind of shows you where Wall Street's at right now. Some people are in Delulu land, and I love the bulls and I love the bears. And when I'm bearish, I like to, challenge my opinion more on the bull side. And when I'm too bullish, I like to challenge my opinion on the bear side. And well, there's not a lot of challenging right now for the bear side. There is a lot of things that are working against us in markets. September is seasonally the worst month for stocks. Normally, over the last 10 years, by far, September takes the cake. It's bad. October, though, during election years, tends to be even worse than September. And that's not a good position to be in when you had a bad jobs report on Friday, when you're getting some really mixed bad data. For an example, take a look at job openings in the construction sector. Ever since February, they have started to fall with a little bit of a rebound from April to May, but from May until today, they're really starting to collapse now, something that you normally see during recessionary environments. Or what about this from the Wall Street Journal that said, quote, using a 3-month moving average to smooth out this and other monthly volatility, the underlying trend is clear. The economy added an average of 116,000 jobs in the 3 months through August, down from 141,000 in the 3 months through July. In fact, this average has been moving downwards for 5 straight months. There's no doubt about it. Things are weakening at a pretty aggressive pace at this point. Or what about this? From the Kobisi letter, job cuts at U.S. companies jumped 193% in August to 75,891 from 25,885 cuts announced in July, according to the Challenger report released Thursday. A lot of, Wall Street tried to write off the last jobs report that we got, not the one that just came out for August, but the one that came out for July, to say that, well, we just got the rise in unemployment because more people entered the workforce and the Hurricane Beryl in, I believe that was June, affected the numbers. And that's a really hard argument to make with the data that we got last week. I mean, if you actually look at this chart, This November 2022 prior high was like 155,000 challenger job cuts. We're at 175,000. So in fact, this is actually not, updated. This would be literally off the charts and to the right if this was an updated chart. Way up here at 175,000. Well past anything you've seen at the end of 2022 when a lot of people, a lot of firms, a lot of companies thought we were actually heading into a recession. Now, this is also pretty troubling. It says here, ChatGPT website visits are apparently collapsing, according to data from SimilarWeb compiled by Goldman. Is this why they were considering the ridiculous $2,000 a month subscription and desperately trying to raise funds before the large language model bubble burst? I do think LLMs have potential, but I also think that their capabilities have been massively overstated in the here and now. We're at the peak of inflated expectations, and that's exactly what you see here is going from 1.8 million visits a month, or 1.8 million visits a month. That could be 18. Is that 18? 18 million visits a month. Yeah, 18 million visits a month. Down to like 200,000 visits a month, 2 million visits a month. It's kind of weird how they have this chart. Usually charts like this are in thousands, maybe down to 2 million visits a month. This thing is collapsing. I mean, maybe that's why you're seeing AI stocks not doing well. That could make a lot of sense. The point is I'm trying to make here is there's not a lot going for markets in the near term. September is a bad month. October during election years is a bad month. We just got some pretty mixed downwards tilting data. And September, has already started off on a bad note. We're heading into the first Fed rate cut, September 18th. And most of Wall Street right now has the mentality of, you should sell the first cut, because in fact, the Goldilocks period during Fed hiking cycles and then cutting cycles is actually after the last hike, but before the first cut. So the last hike that we seen was July of 2023. We've had 14 months of this Goldilocks period, and we've seen what stocks have done. They've done very well. Now you're heading into the first cut from the Fed, and that's usually a moment in which you want to fade that. You want to have some protection on your portfolio. You want to be in more cash than maybe other times you're normally not. And again, most of the time, stocks sell off after the first cut from the Fed. That's what a lot of Wall Street is starting to say now, is stocks can actually fall after the first cut from the Fed. And that is coming right around the corner. Right around the corner. It is September 8th. Tomorrow is September 9th. The Fed cut is literally 9 days away, less than 2 trading weeks away from today. I'm not that optimistic in the near term for markets. I also see a big disconnect, like a massive disconnect. I've never seen anything like this, to be honest. And I've been in the market since 2016, 2017. Started to, really get into markets around then, where you have an economic outlook that does look more negative now than it did before. But the market's just unwilling to price in any downside potential, any chance of a recession, or any chance of EPS that comes in a little on the light side. Like, earnings estimates are at all-time highs still for 2025. That is a little ridiculous, okay? Because the upshot there is what? If we're pricing in 15% EPS growth for 2025, you need like 20% EPS growth for 2025 to impress investors. That's crazy. If you're thinking about the S&P 500 as a whole grows EPS by 20%. Like, seriously? With the economic data that we're seeing, it's not like we're money printing right now. Things are not very accommodative, to say the least. We're 225 basis points in restriction if you judge neutral at 3% for the federal funds rate. Like, that's really the backdrop? You want to be expecting 15 to 20% EPS growth for 2025? No, even a lot of bullish fund managers recently have said earnings estimates are too high for 2025. And we're going to take a look at this clip that from CNBC that basically says the same thing. Take a listen to that now.
In fact, in about a year and a half, NASDAQ taking it on the chin today. It's on track for its worst week since January of 22. Joining me now, Post 9, Morgan Stanley's Chris Toomey. Welcome back.
Thank you.
All right, what's your take?
Look, last time we were here, economic number was kind of in Goldilocks view situation, which was giving the Fed exactly what it wanted to do. What we saw was a situation where prices had gotten way ahead of themselves. We thought we were probably experiencing a situation where something was going to have to pull this back. You know, we got a bad employment number at the beginning of August, then we got some decent numbers in between. But I think the big thing that's changed is bad news is bad news, right? Like, it used to be bad news is good news, now bad news is bad news. And the other thing is, good news is not great news, so good news is now bad news, right? So you had...
Is good news bad news? And I would take issue in even some respects that what we've gotten is quote unquote bad news. We're acting as if the economy is in some tailspin. The data would suggest otherwise.
I think the data is, if you look at earnings are actually okay, right? The Mag 7 numbers, the most recent one, was actually not bad. I mean, the question is that, you know, everything is priced to perfection, and if it's not great, it's got to be bad. You know, the employment number today, you know, you've got Steve Leisman on all the time. He looked at it first thing and he said, it's not bad, right? But the market's acting like it's horrible. And so I would say the economic data is not bad. I think the economic data is fine. I think the pricing was off, right? So the pricing's come back.
I don't even know if the market is taking it like, oh, the data was so bad. I think we're starting to get into a conversation as to whether the Fed is going to blow it or whether they already did.
No doubt, right? Because, I mean, the thing is, we're in a situation where they've kind of threaded the needle here with regards to kind of moderating growth, bringing down inflation, raising up unemployment, and the market's been doing well. But the problem is that, you know, we're at an elevated place for rates. We were just in a period where we had 15 years of zero interest rate environment, and there's about a 6-month drag before they start cutting rates, right? And so you're in a situation where markets are priced for perfection. They're expecting the Fed to continue to be able to defy gravity, and maybe that's not going to happen. And so that has to be priced into the market.
All right, so we recalibrate. We need to recalibrate.
Absolutely.
But that doesn't mean we need to completely fall out of bed either.
Well, I mean, you know what it is. I mean, it's you know, stairs up, elevator down, right? So the market gradually goes up. It keeps kind of getting into this positive feedback loop of everything is going to continue as it is. And then all of a sudden it's like, wait a second, this isn't happening. And we get the elevator down, right? And so that's the reason why you have to be cautious when the market moves as aggressively as it has without any of these pullbacks.
Part of your point, again, it's like parts of the market took the stairs up. Big tech didn't take stairs up. They took a rocket ship. And now they need to come back down to earth a little bit.
That's right.
The problem is we don't know how much.
Well, I mean, I think we do. I mean, look, if you look at it from a pricing standpoint, you've got rates coming down, so the equity risk premium is actually becoming a little bit more attractive. You're in a situation where they're continuing to provide great earnings. In our view, it's a situation where you still want to own these names. You just want to own them at the right price. And so in our view, market had to come back a little bit. You were going to expect to see the Mag 7 get hurt and drag the market down and all the other names that have been benefiting from it over the last 18 months. And now is the opportunity where you can start looking selectively at opportunities, whether it's in the 493, right? Or looking at some of these Mag 7 names and saying, look, I didn't own these names when they were at this level, but now they're at a more reasonable level. We can start owning these things.
Is that what you're thinking about?
100%.
For your clients?
Absolutely. So, I mean, look, we've been waiting for this pullback. We've been sitting on cash. We've been collecting the types of income that we like to collect, but we thought the markets weren't really justified with the right type of risk that were in there. And so that now the prices are coming back, we're getting a little bit more interested in putting some money to work.
Interesting. So you thought the price was wrong. Now the price looks a little better. You're also implying that you don't think the the pullback goes much deeper than here.
No, I think it could. But that doesn't necessarily mean we're going to try and call the bottom. What we're going to do is we're going to look and see where the valuations are, how this fits into clients' portfolios, and we're going to start buying the names that we really like that we think we can get at good prices.
How are you looking at volatility? VIX up 14% today, right? It's north of 22, and then election risk, 60 days away.
Right. So, I mean, look, I think people have talked about, I don't know if you know this, but September's not a good month with regards to investing. Elections also can be a problem for investing. And so in our view, that increased volatility is what we love. We like to take advantage of it, whether it's buying names that we think are unduly getting penalized or just writing call options on it and collecting extra income. So we like this volatility. We think it's going to stay. We didn't talk about this. I think one of the most important things that has been going on in the market is the buyback situation. So buybacks tracking almost 2 to 3 times than it historically has. That's going to end at September 13th once we go into earnings. So that's going to be another wave of problems that we see going into the next couple of weeks. So in our mind, we're not rushing into the market. We recognize this is probably going to continue for a little while, but this is giving us a good opportunity to add some money.
All right, this is a good place to leave it. It's good to see you again. Chris, thanks. This is Chris Toomey, Morgan Stanley, joining us here at Post.
I actually really like that perspective, so I wanted to share it with you. I agree with a lot of what he says. Now, again, if we go into a recession, if the data gets worse, that's really going to dictate where markets go. But I do think there is opportunity out here. Do I like big tech? No. I actually like NVIDIA more than I like Apple or Microsoft or Google or Amazon. I'm cozying up to that one a little bit. But, Amazon, specifically NVIDIA, I actually think those names could be decent for the next 12, 24 months of returns, okay? They're not priced for perfection anymore. They're still up there, but not as priced for perfection. Let me know what you thought about that clip down below in the comment section. But that's really the main point here. Again, September, usually not a good month. October is usually not a good month during election years. We have a 0% chance priced in by the markets of a recession. If we continue to get bad data, mixed data, data that shows the economy slowing down, we're going to need to start pricing that in. 10% chance of a recession being priced in is going to lead to downside. 20, 30, 40, 50% chance of a recession getting priced in is going to lead to a lot of downside. In 2022, we fell 27% from top to bottom. At one point, we were pricing in a 100% chance of a recession. Could that happen again? Absolutely. From all-time highs, we're only down 4.5%. There could be, 26% more downside from here if we actually have to price in a recession. That's why I don't think panic buying into this market makes a lot of sense, because we are still up a lot and there's still a lot of elevated expectations. But there is definitely some stocks out there that do offer a lot of potential rewards and a good risk to reward, like high-paying dividend stocks. They become more attractive as the Fed starts to cut rates. Cyclicals, if the economy avoids a recession, they're pretty well priced for a recession right now. Even, I know some people are going to hate this, but Dollar General, right? The stock's gotten absolutely obliterated in recent weeks. That could be a good opportunity to start nibbling and buying the dip. So there's definitely some opportunities out there, but there's a lot of risk for markets to come. And I don't really see the strong economic data that's going to come out and bail us out heading into the first Fed cut, which historically is something you want to fade. You actually want to be a seller historically of the first cut and then wait a couple of months to get back into the markets if you are a market timer, if you will. This period in time tends to be an easier one to kind of game out the markets, if you will. Now, you also have the 2- and 10-year yield curve inversion that is inverted or uninverted now, 6 basis points. That's the most we've been uninverted this cycle. Normally, when you uninvert on the 2- and 10-year, that's when the pain starts. That's when you're on the doorstep of a recession. Now, normally, you're declared in a recession like 6 or 9 months after you're already in a recession. So it's kind of backwards looking to say, hey, we were in a recession then and now we're kind of going out of it, right? So that whole process is really flawed. But normally you're about 3 months away from actually going into a recession historically when the yield curve uninverts. You have now uninverted on Friday, 6 basis points. that's usually a surefire sign to, fade whatever rally you're seeing to raise cash and get ready to, buy the dip or whatnot. So I just think minus any really good economic data, we're probably going to have a pretty rough next 8 to 12 weeks in markets. Wouldn't surprise me if the economic data gets even worse in November, December, and that could be an even worse time for equities. We'll obviously have to wait and see, and political agendas can obviously, influence that as well. But for the week ahead, let's take a look at Monday. You have wholesale inventories month over month, expecting that to go up, which should actually be good for potentially GDP estimates. We'll see. We'll get a new GDP estimate from the Atlanta Fed GDP Now tracker coming out on Monday. We can see the latest update that we have, if this will update, is 2.1%. So we're currently expecting 2.1%. We'll get the new one Monday, September 9th. So coming out tomorrow. Based on that inventory data, you get the balance of trade, you get Westpac consumer confidence change. None of that's really going to be too important at all. Tuesday, you don't get anything. Okay, you have a 42-day bond auction, a 3-year bond auction. You do have the NFIB Business Optimism Index. You're actually expecting that will fall a little bit after it recently went up last month. And that was some of the mixed data that we've seen where, some people on Wall Street said, well, people are growing more optimistic. And it's just one survey, so don't draw any conclusions. But, if we do have a good day on Tuesday, it's probably because that thing came in better than expected. Now, this week we have core CPI, and unlike years prior, I don't think inflation is any longer a catalyst for markets. I think to a slight degree, if inflation comes in hotter than expected, sure, that can be a negative catalyst. But I don't really think too low inflation is going to be positive also, right? You don't want to go into deflation. Deflation is like the killer of bull markets. Deflation is the killer of economies. Inflation is bad, but deflation is worse, right? So we've been kind of getting pretty close to being deflationary here over the last couple of months. The last thing you want's a negative, core CPI number. So let's hope that does not happen. You're expecting 0.2% for core month over month. Year over year core expected at 3.2%, unchanged from last month. Headline month over month expected at 0.2% as well. And then your year over year inflation is expected at 2.6%. Last month was 2.9%. So expecting the biggest fall on year over year CPI. But obviously, people pay more attention to the core, so that'll be really the area to look for. Thursday, you're going to get the PPI data. You're expecting 0.2%, up from 0.1% last month. Initial jobless claims expecting 231,000, up from 227,000 last week. You get PPI, continuing jobless claims, an ECB press conference. You get a couple other things. But I don't think anything's really going to be too impactful on Thursday. On Friday, we'll get Michigan consumer sentiment for September. You really want to watch the current conditions and consumer expectations. Current conditions have been weakening a lot recently. This is the chart for Michigan current economic conditions. This is the University of Michigan, okay? It's not the state of Michigan. And how the citizens of Michigan feel. I live in Michigan. Trust me. The chart would probably be worse than that. Okay. Go talk to anyone. If you live in Michigan, they probably don't feel great about current economic conditions. But this is the chart that of basically the U.S. and current economic conditions. It doesn't look great. Okay. Not at the lows where you were at in June of 2022 when inflation was really starting to bite, but you're starting to fall a lot. And that's a big one Wall Street's going to be watching out for, as well as consumer expectations that have actually come up a little bit. This is more forward-looking, but still not in a great place overall, still well below where you were pre-pandemic. So I think those are the two big things you really want to watch for as far as the data on Friday. But unfortunately, this data is not as big or impactful as the jobs report we had on Friday. I really think the jobs report was the decisive factor for September. You know, if it was really good, we've seen the unemployment rate, if it were to fall and 200,000 jobs created, then I really thought September was going to be a great month for stocks. If we had a bad jobs report and markets reacted negatively on that, you know, I thought we were going to have a bad September, and it's looking like we're going to have a bad September now. And, you know, unless we get something of equal, you know, importance that comes in good, we're setting up for a tricky next 8 to 12 weeks. And I do think cash is king right now. There is opportunities that you definitely want to take advantage of. I mentioned some of them here in this video. There's plenty of others. Small caps look even pretty attractive here, especially higher quality ones that can benefit from rate cuts. You know, cyclicals, high paying dividend stocks, like a 4.5% quality paying dividend stock right now looks pretty attractive, as the 10-year treasury is at 3.65%. As short-term money market fund rates start to move lower, as the Fed cuts rates, they will lockstep move with the Fed. You know, 1 month, 3 month treasury bonds, for an example. As those start to come down and we get to like 4%, that's when you're going to see those dividend stocks really start to gain some attractiveness, right? And I think that's where you get the ultimate appreciation in those areas. So I think you have some time, right? It's time to be patient here, but there is definitely a lot of opportunities you want to take advantage of. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.